Welcome to the CFA Level 1 lecture on market efficiency. I'll begin by quoting from the curriculum, which says that market efficiency concerns the extent to which market prices incorporate available information. So essentially, when we talk about market efficiency, we are really talking about informationally efficient capital markets. Informationally efficient means that all information related or all relevant information is incorporated into security prices. So if that is the case, where all information, all relevant information is incorporated into security prices, then we say that the market is informationally efficient. And a shorter version of saying that is that the markets are efficient. So what are some of the implications of a market being efficient? Those implications are outlined here. In perfectly efficient markets, the market value of securities is equal to intrinsic value. So this is an extremely important statement. And let's just make sure we understand what these terms mean. The market value for a security, let's take a security such as FFC, which is a stock that trades on the Karachi Stock Exchange. If the market is perfectly efficient, then the market value of FFC, so this is the price at which this stock trades in the market. So let's say that this stock is currently trading at 150 rupees. So that is the market value of the security. So in a perfectly efficient market, this market value will be equal to the intrinsic value. The intrinsic value of a security, also sometimes called the fundamental value, is the value that we determine a security should have based on all available information. So given the sorts of techniques that we will use later on, where we will talk about calculating the appropriate cost of capital for a given security, we'll talk about the cash flows. So given the economic fundamentals, the value of FFC that we calculate is called the intrinsic value or the fundamental value. In an efficient market where everyone or all people who are valuing the stock or everybody who's interested in buying and selling the stock, if they have all the relevant information, and then basically the market value of that stock will be equal to intrinsic value. If market value is not equal to intrinsic value, then the market is not efficient. Another implication of efficient markets is that we should use passive investment strategies, and this again is important. So if the market is efficient, this would imply that the value that the security is trading at, which is the market value, is the intrinsic value. So this implies that all securities in an efficient market are fairly valued, and if securities are fairly valued, then it makes sense to use a passive investment strategy where we simply buy stocks. So if we want to invest in stocks in Pakistan, then it makes sense to simply buy based on the KSE 100 index or some other index that we want to track. And essentially we then avoid an active strategy. In an active strategy, what we are trying to do is do some aggressive research to figure out which stocks are undervalued. But if markets are efficient, then stocks will not be undervalued, and hence the cost of all this research and other active work is essentially a waste. And therefore, in an efficient market, we should use a passive investment strategy which keeps our investment costs as low as possible. And finally, in an efficient market, only unexpected information impacts security prices. The point here being that if the whole market is expecting a certain piece of information, so for example, let's continue with FFC. If the market expects that FFC and other fertilizer companies will increase prices, then that fact should already be built into the security price. Only if a given player announces unexpectedly that prices are going up or that there is some other impact, so only if there is some unexpected information, only that will impact security prices. Again, just to hammer in the point, any expected information will already have been built into the security price if we are operating in a efficient market. So how can we tell whether a market is efficient or not? One criteria we can use is to look at the time lag from information dissemination to a change in security price. So to give a current example, Engro recently announced that they are going to increase the price of their product. So if this announcement immediately resulted in a change in the price of Engro shares, that would imply that there is reasonable efficiency in our market. Now this is just a point example to illustrate the fact here. I'm not making a case that the Karachi stock market is efficient, but nevertheless the point here is, if the time lag from information dissemination to a change in price is very short, that sort of implies that the market is efficient. And finally, for this slide, just a couple of important terms that you will hear. You will hear a term which is efficient market theory, or you might hear a term efficient market hypothesis. So just make sure you understand what these mean. Efficient market theory is essentially the theory that markets are efficient, and as the term implies, this doesn't necessarily mean that all markets are efficient. It simply means that somebody might say that markets are efficient, or that a given market is efficient. That is a theory, and the theory can be tested through empirical tests. And efficient market hypothesis essentially is the same thing. It is simply a hypothesis that the market is efficient, and we can then do some tests to either prove or disprove the hypothesis. And this should remind you of quantitative methods where we did hypothesis testing. In the context of efficient market hypothesis, we set a null hypothesis that the markets are efficient, and then we can do, so the null hypothesis is markets are efficient. The alternate would then be that markets are not efficient. We then do several tests to determine whether or not the null hypothesis holds. And as you will see later, typically when we talk about this efficient market hypothesis, or EMH, there are three forms of this hypothesis: the weak form, semi-strong form, and strong form, which I will cover later. Now let's talk about the factors which affect a market's efficiency, and from an exam standpoint this is very important. The way you will be tested on this is, you will probably be given a scenario and be asked whether that scenario is going to make the market more efficient or less efficient. So for example, if we have a situation where short sales are not allowed, does that make the market more efficient, less efficient, or does it not impact efficiency? So at the end of this slide I am going to come back to that question, but just keep it in your head for now. Okay, so what are the factors which affect market efficiency? Number one, how many market participants do we have? If the number of market participants is high, then chances are that the efficiency of the market is high. The idea being, we have several market participants who are carefully evaluating securities, and if we have several participants, chances are that any change in information or any new information will immediately result in buying, selling activity, and the price of the market, of the price of the security, will adjust rapidly. So the point to remember, higher the number of participants, higher the efficiency. Number two, availability of information. So here the point is again straightforward, that if we have information easily available, lots of information available to all relevant parties, then again the efficiency is going to be high. Limits to trading. Limits to trading implies that if there are high limits to trading, then the efficiency is low. Limits to trading implies that the operational efficiency, and this is another important term, so operational efficiency. So if the operational efficiency is low, then the overall market efficiency will also be low. Point being, if it's hard to trade, or as I described at the beginning of this slide, if there are limits to short trades. I hope you remember from the last few lectures what short trade means, or what a short transaction means. In a short, trader borrows and sells. So one does a short sale when he thinks that the price is too high. So if short selling is not allowed, then chances are that prices might be a little higher than they should be, because with high prices, if people cannot easily do short selling, then that makes it difficult for the prices to come back down. So as far as you're concerned, just remember the fact that if there are high limits to trading, that implies operational efficiency, which means that implies operationally the market is not very efficient, and hence that means low market efficiency. In this context, also understand this term called arbitrage, which I have mentioned briefly before, but I'll talk about again. Arbitrage is a situation where an investor can make profits without taking risk. So the point being, if a market is inefficient, or if there is mispricing of a security, then because of arbitrage, traders are going to do a lot of transactions. To give you a simple example, let's say a given stock X trades both on the Lahore Stock Exchange and the Karachi Stock Exchange. And let's say that this stock is, let's say, overpriced in the Lahore Stock Exchange and underpriced in the Karachi Stock Exchange. So if it's the same stock, clearly there's an arbitrage opportunity here, where investors will start, or traders will start buying X in the Karachi Stock Exchange and selling in the Lahore Stock Exchange. So this is arbitrage, and enough of this will happen very quickly. When arbitrage happens, the price in Karachi will go up because people are buying, and the price in Lahore will come down because people are selling, and essentially the market will become efficient very fast. So thanks to arbitrage, as long as there are no limits to trading, the mispricing will go away very fast, and that would imply a efficient market. Transaction costs, I have implied this earlier. So if transaction costs are high, then the market efficiency is low. The idea being this: if it costs a lot of money to buy a security that is underpriced, obviously a trader will consider those costs when making a buying decision. So that might result in a security remaining a little underpriced because it is simply too expensive to buy it. And finally, information costs. If it is very costly to get information, then again the market efficiency will be low. So again, these two are related to operational inefficiencies. Let us now understand a few important terms in the context of market efficiency, and these terms are used frequently in questions related to market efficiency, so it is important that you understand them. Fundamental analysis. This refers to the analysis that you might do where you look at the economic fundamentals of the company and the economy and then come up with the appropriate price. So if you do discounted cash flow based calculations, or you do price earnings ratio based calculations, and these are things we'll talk about later. Plus most of the CFA curriculum, level 1, level 2, level 3 is based on evaluating securities using fundamental analysis. So this is understanding what fundamental analysis means is important. You also need to know what technical analysis means. We talked about this during quant, but essentially technical analysis means that you look at market data. So you look at things like price charts for stocks, how many people are buying, how many people are selling. You look at the sentiments in the market. So if you are buying and selling, or basically analyzing securities or the market based simply on market data, stock data, then that is called technical analysis. If you are uncertain about this, you need to go listen to the lecture on technical analysis again, which is the last reading in quantitative methods. Abnormal trading profits essentially refers to generating a positive alpha, and we talked about this earlier in equity. So Jensen's alpha is the excess return over what you might expect. Let me explain with an example. Let's say you build a portfolio with a beta equal to 1, and if beta represents the riskiness or the systematic risk of the portfolio, if the systematic risk of a portfolio is 1, then the expected return of that portfolio should be equal to the market return. Why? Because the market has a beta of 1. So if you build a portfolio with the same level of risk as the market, then the expected return of this portfolio should be equal to the market portfolio. Let's say that in our example, the expected return for the market is 17%. Now, if you can build a portfolio with a riskiness represented by beta equal to 1, and on a consistent basis you can exceed the market returns, then that means you are generating abnormal trading profits. And again, abnormal trading profits here, if you were to on average generate 17%, then that is normal trading profits, because you are generating profits that are comparable or in line with the level of risk. And again, to emphasize, if on average you generate returns on your portfolio equal to 19%, then your abnormal profit or the alpha on average is 2%. So this is abnormal trading profits. You also should understand the distinction between market and investors. So an implication of the efficient market hypothesis is that on average markets are efficient. This doesn't mean that every single investor will operate in a rational way. So the assumptions that we make about during when we talk about capital markets means that overall, that on average investors behave rationally. So when we talk about investors on average, that essentially means that on average the market is behaving rationally. The market being the combination of the investors. So it's important to understand that an individual investor being irrational does not contradict efficient markets. It's essentially the combination of investors who are operating in the market. Generally, they will operate rationally on average. And finally, for this slide, let's talk about types of information, and then we will use this on the next slide. Broadly speaking, in the context of efficient markets, there are three types of information. First, you have market data or security market information. So this is current and past data related to stock prices, volumes, etc. So if you are looking at the chart for a given stock over time, then this is an example of market data or security market data. Then the next category is public information. So this is all public information related to security markets, related to the economy, related to politics, etc., etc. Because pricing of a security, when we do fundamental analysis, we not just look at market data, but we also look at all other economic and political data that might have an impact on security prices. So category 2 is all public information. And category 3 is non-public or private information. So essentially this is all information, both non-public as well as public. So the idea being that there might be some information that is only known to the market makers, or information that might only be known to senior executives of a company. So that information is non-public or private. And this category 3 essentially includes 1 which is market data, 2 which is public information, and 3 non-public or private information. So 3 includes 1 and 2. Category 2 here includes 1, and obviously item 1 is just on its own. Now that we understand the basic terms, let's talk about the 3 forms of the efficient market hypothesis. Sometimes this is just called the efficient market theory, but more often it's referred to as EMH. So this is the hypothesis that markets are efficient, or more specifically the hypothesis that markets are informationally efficient. But there are 3 flavors to this. The first flavor is the weak form. So let's just first understand what this means, then we'll talk about the implications and then how to test for this. The idea with weak form is we say that a market is weak form efficient if all security market data is incorporated into security prices. So essentially this means that all data related to market prices of stocks, volumes, etc., is incorporated into the prices. So security market data is included, but all information, all public information and then all private information is not necessarily incorporated into security prices. So only security market data is incorporated. So the implication of the weak form analysis is that you cannot use technical analysis to get abnormal profits. Given that all security market data is already incorporated in the prices, you then cannot use technical analysis to make abnormal profits. And how can we test the weak form? So basically we can look at past data and use several technical analysis techniques and see whether those techniques would have given us abnormal returns. And in general, these tests have shown that by and large markets are weak form efficient. Next, let's talk about the semi-strong form. In the semi-strong form, we say that all security market data plus all public data is incorporated into stock prices. The implication being that we cannot use fundamental analysis to make abnormal profits. Why? Because all public data and then by extension all security market data is already incorporated into stock prices, and hence using fundamental analysis is pointless because all this public information is already built into the stock prices. So we cannot earn abnormal profits by using fundamental analysis. And finally, how do we test for this? The way we can test whether semi-strong form holds is through several kinds of studies. One popular form is called event studies, where you look at the reaction to stock prices based on events. And a classic event is to look at, say, earnings surprises. Now, if you follow a strategy or conduct a test that looks at whether an investor could make abnormal profits by investing in stocks where there is a positive earning surprise. So if this test shows that you can make a abnormal profit, then that would imply that the market is not semi-strong efficient. On the other hand, if you do a test where you look at what would happen if you buy stocks where there are positive earning surprises, and you notice that on average the returns that you make are equal to the normal profits, that would imply that any earning surprise related information gets incorporated in the stock price very quickly, and that would imply that the market is semi-strong form efficient. In the next few slides we will talk about various anomalies which suggest that there might be certain circumstances where the market is not semi-strong efficient, but the purpose for this slide is to just ensure that you understand what it means if we say that the market is semi-strong form efficient. Just as a general point though, by and large evidence suggests that at least in the developed markets, the markets are reasonably semi-strong form efficient. And finally, the strong form of the efficient market hypothesis says that all information, so that is security market information plus public information plus private information, is all incorporated into security prices. So the implication of this is that no one, not even insiders and not even market makers, can make abnormal profits. So basically this says that no one can make abnormal profits. And how do we test for this? The way we can test for this is by basically looking at whether insiders and market makers can make abnormal profits or not. Evidence suggests that by and large most markets are not strong form efficient, because there is sufficient evidence that market makers as well as insiders do tend to can make abnormal profits. So these are the key points that you must understand with regards to the three forms of the efficient market hypothesis.